Good afternoon, everyone. Welcome to the TheoTRADE afternoon video. I'm Blake Young. Today is February 8th, 2024, and we're going to look at bonds and dollar reach inflation inflection point. Before we get into this key level of inflation that may be about to turn to deflation, let's take a look at the broad market. We're going to start with the S&P 500, the S&P 500 being the broadest measure of an overall cross-section of the entire stock market. So not overly heavy into tech stocks, not too small stocks. It's the Goldilocks S&P 500. And you'll note that we've rallied. The ES futures touched 5,000 today. The SPY is nearing 500 as well. And if you see here in the background, this 80% level is my projected monkey bars for the year, saying this is the yearly overbought zone. And so we touched that today. Went up there and just touched the overbought zone and struggled. But notice as we're reaching this height, on the moves higher, on the breakout higher, we've had no volume. So as we push to these higher highs, these key levels, the record highs in the Nasdaq and the ES, we're doing so when the dollar is stabilizing. And so if the dollar is stabilizing, the idea is the dollar's purchasing power is not weakening while the equity markets are rallying, which seems to indicate that maybe we're not seeing the equity market push to these highs on low volume because of inflation, but rather just that momentum push. And we may be at a key level. We saw some additional information with the bonds today, and we'll get to that momentarily. But to start out again, S&P 500 all the way up to new record highs. The last 3 days closing higher on lighter and lighter volume. As we look at the moves in the market, inflation and disinflation is what many economists will call it. Deflation is what some others will call it. The idea that the purchasing power of the market or of the currency that you're trading in is getting stronger versus the cost of assets. So assets like commodities, gold, silver, copper, oil are coming down in an underlying currency that is disinflation or deflationary. Even if the money supply is increasing, that would be the time that we say money supply is increasing while prices are coming down. That's disinflation, and that's kind of what they look for. But remember our little indicator that we've used before, comparing bond prices to commodities or bond prices to general commodities or gold, and doing that as a long-term ratio to get an idea of how high inflation is run. Let's start by adding that to this chart by going into studies and going to the price or the price ratio. And we're going to change this. Currently it's set for SPY and gold. We're going to change this. And let's start out with DBC, Deutsche Bank's commodity fund. That's going to be our first indicator. And our second one is going to be what we consider a risk-free premium or risk-free return that comes from bonds. And we'll get to the longer-term bonds, the 30-year bond auction today in a moment. So we have DBC and bond prices. We've used this before. And we're looking at this ratio as an indication telling us how inflation is moving. DBC, as the indicator, going back to a 3-year chart, has been all the way up to these highs last year in 2022, and we've kind of created this lower high, lower low, lower high, and this week we just cleared the lows. So this little tiny move cleared the lows barely, and we're sitting here at what I'm going to consider support. In essence, the lowest inflation value going back all the way to February of 2022. So we're 2-year low in inflation when comparing DBC, general commodities, to ZN bonds. Let's do the same thing with gold. Look at the gold hedge, and we'll do that by changing this from DBC to GC. We're going to use the gold continuous futures contract right through there, and we'll just compare the two that way. When we adjust for inflation hedging with gold, you can see that we're all the way here at the top. We've tested the lows, and we're struggling moving higher. So even with gold versus bonds, we're holding at these all-time highs, this high inflation number, but we're not advancing. We're not showing signs that inflation is going up anymore. We also know that the Fed has indicated they're not going to cut rates, and so the market's trying to price that in that, hey, we may not see rates cut, which means that we're not going to see a return to inflation if rates stay relatively high. Now let's talk about that in conjunction with bonds, and then we're going to find some trade opportunities that come from inflation and deflation. If we look at the bond prices, just again, the bond futures, is the 30-year bond. We had the 30-year bond auction today. You can see that the bond prices sold off. We dropped about 1% before recovering to end the day down about 0.72. Bonds had lower demand. That's what this tells us. Bond prices fell as the market reacted and responded to the bond auction. The bond auction required that the Fed offered a higher interest rate. The peak inflation rate or interest rate was one that was higher for the same amount of demand. What that means is that the Fed goes out and says, hey, we have these 30-year bonds. What do you want to do? Do you want to buy them from us? And they say, well, what are you going to offer us? They say, well, we'll give you 4.2%. And there's not a lot of buyers. They go to 4.25, 4.3, 4.34, 4.35, and today came in at 4.36% yield on the 30-year bonds. And that's where they got this similar demand. So if they had to raise rates to offer at 4.36%, that decreases the value of previous bonds and future expectations, as the Fed had to offer a higher interest rate to get those sold. We've dropped back down to what I see as a fairly key support and resistance level. You can see we made lows here, lows here, lows here, lows here, lows here, and that takes us through much of the year as a key level. But it's the interest rate and the yield that we're seeing that is accompanying this that tells me that we're at a key level. Either we're going to break higher with inflation, or we're going to turn and roll down. And there's some additional information we can look at here shortly. If we look at the TNX, the shorter time frame treasury yields, you can see that we bumped up and are hitting our head at resistance. This key resistance across through here takes us back 2 months. If we break through this, just like any other technical analysis, if we break through the high on the 10-year treasury yield, we should expect the bond prices to be breaking through the low. We should expect the same size of move to be repeated, and we should be going from about 3.8% and up to 4.2. So we're looking at about a 0.4% increase, which means yields and therefore borrowing rates are going to likely increase by about 0.5%. 4.6% will bring you back up to here, and that brings us back to the interest rates and the borrowing rates that we saw back in November, and maybe even higher. And if that's the case, we know that up here, home sellers were not selling homes. We know that borrowers were not borrowing. And if we push up to those higher highs, that would be an indication of no demand. Higher costs would have people not borrowing, not spending, and the lack of demand would likely see inflation turn off. Higher rates are how we're trying to manage inflation. So if the market simply lifts rates, drives bonds lower, then the demand will stop and inflation will come to a screeching halt. One sign that we can already get in conjunction with this idea that we're at this key point, that we're about to either see inflation go higher, that would happen if they cut rates, or stop moving higher and go into disinflation or deflation area, would be China. If we look at China as a representation of demand, you can see that we've been making lower highs, lower lows, lower highs, lower lows. This is the Chinese large cap ETF. So these are the big companies in China, and they have been losing and losing and losing. They're down nearly 33% since August. And as you can see today, we gap down and moving down lower. One of the things we can also look at is the news that they're actually seeing the biggest price drop, deflation risk, since 2009. They've not seen that kind of deflation and disinflation in food and other commodities since 2009. They have already capitulated, turned the corner, created that inflection point, and gone from raising or seeing prices rise, and now we're seeing deflation or prices fall compared to the yuan. If that's what they're seeing, then their prices are starting to fall, and they're willing to sell their stuff to us for cheaper. But it is likely an indication that demand isn't there. They're not selling the products either within the country or outside of the country, and that's creating this disinflation or deflationary risk. One of the number one instruments to gain during inflationary periods is crude. Crude and some of the companies that are inside crude, such as the oil producers, the oil exploration, upstream and downstream crude or oil companies are the place that generally get a higher return. So during an inflationary time period, oil in general does about 40%, and individual equities can do 70, 80, 90% during those inflationary time periods. Now again, we can only go back to about 2003, but you can see from 2003 until we saw this spike, we had the returns from inflation picking up right through here. Oil prices gained all the way up 82% a year. And if we waited until they peaked out and rolled over to tell us that inflation was stalling and even crossed that yellow line, even then we're averaging about 33% a year on average. Not picking the top, not picking the bottom, 82% per year. 32% per year during that time frame. Then we saw disinflation or deflation prices go through here as those crossed down and they crossed back up. Oil again went all the way to these peaks. There's your 80-some% return. And if we waited till it rolled back down, we're seeing again a 30 to, in this case, 15% return in that same time period. So crude is one of the top performers during inflationary time periods. Gold doesn't even have that kind of performance. Gold is a hedge, but not an outperformer when it comes to inflation and growth. So if you have growth and inflation, oil is the top, well, the number one. Emerging markets does very well during that time frame as well, but you have to ask yourself, are we seeing that growth in emerging markets? You can see back through here again. I can't go back to 2003 on this chart for some reason, but it was 2003. 2003, you can see that gain was 402%, 88% a year, almost identical to what we saw in oil. And then after we saw that peak and roll over, if we go through there, there's your 32% return. So almost identical to crude. EEM gained about 80% during the highest point and about 30-some% per year by investing during inflationary time periods. Now the reverse is true too. If you're seeing disinflation, you might be able to sell premium and collect that, but there's others that can benefit better. So if we know that these are the two that benefit the most, EEM and oil during inflation, what struggles? What really has a difficult time? During inflationary time periods, you might look at something like a high yield instrument. You look for fixed income, and the fixed income and high yield stocks generally suffer during that time frame. And again, we can't go back to the 2003 time period, but the idea would be looking for these to not do well and struggle during inflationary time periods. Now this one created equal highs, equal highs, equal highs, but reality is it lost about 20% a year during this decline while inflation was still climbing up to these peaks. We could do the same thing with something like an emerging markets bonds. So keeping to the fixed income view, we'd look at something like this, and you can see a similar drop. Lower highs, lower highs, lower highs. And from all these peaks when inflation kicked in 2016 down to these lows, they underperformed or lost 33% and averaged about 5% loss per year. That means that during disinflation, like 2008, 2009, you would be looking for those to recover faster and see those 2008, 2009 spikes giving us a return that is 67% or about 15% a year after finding those lows. Similar to what we just were talking about. Now, I'm not going to go off the highest high. I'm going to go back to that 2016 time period and look at that pullback and say, yes, it lost 20%, and as it sits, about 2% a year. It's just in a decline. Great ones to sell premium against, great ones to collect call premium, call vertical premium as those continue to drop. A couple of others that you might find interesting for disinflation or deflationary periods, which ones do well when we're pulling back in inflation, are Cisco and 3M. So in 2008, 2009, when everything else was dropping 60, 70, 80%, they definitely dropped, not the same level. They dropped about half that much, but it's the recovery here. When we see the 2009 all the way up, and as we peaked out inflation, crossed that yellow line telling us the average had pulled back, the deflation or disinflationary time period from 2013 to 2016, you can see that during that time period that everything else may be struggling, they made 56%, almost 18% a year. Same thing as we look at 3M. 3M, same time period. We're just going to go back and say, when did we see disinflation, the pullback in inflation? during that same time period. And what happened? 2013 to 2016, 3M, not picking the lowest price, just picking when it crossed over, 3M went all the way up here and gained 95% during a disinflationary time period when the rest of the market was flat and the Russell was down nearly 20%. So we can see that's a 23% return on something like 3M if it is a deflation or disinflationary time period. So if we are going to follow China into this mix of disinflation and deflation, if the rates are going to remain high according to the Fed, if we're seeing that the bond prices are selling off and yields are going to be propped up higher, it could be time to start looking for those disinflation or deflationary positions, which would include some fixed income certainly, but also 3M and Cisco. And if we see rate cuts being priced back in, if we expect to see more spending, if we expect to see inflation return, then we want to go back and look at oil and emerging markets. Just some things to look at, some things to consider as we're getting to these key levels of inflection. Thanks for watching, and we'll talk to you again next week.